Today, we're diving into the law of business and business organizations, focusing specifically on limited partnerships. We'll explore the key aspects of their structure, how liability is handled, and the way control is distributed within these entities. Understanding these elements is crucial because they affect the way businesses operate, the level of risk for partners, and the management framework. So, keep these points in mind as we move forward to get a clear picture of limited partnerships and their unique characteristics. A limited partnership is a unique type of business organization that combines elements of different legal structures. It involves at least one general partner who is responsible for managing the business and who also carries personal liability for its debts and obligations. On the other hand, there are one or more limited partners who invest capital into the partnership, but typically have liability limited only to the amount of their investment. This structure allows limited partners to participate financially without being exposed to the full risks of the business. Essentially, a limited partnership offers a blend of active management and risk protection for investors. On this slide, we're looking at a key distinction within limited partnerships: who manages the business and who simply invests. The limited partnership is specifically designed to separate control and liability between two types of partners. First, the general partner. This partner has active control over the business. They handle the day-to-day management and make decisions that steer the company. However, with that control comes personally unlimited liability, meaning they are fully responsible for the partnership's obligations. Importantly, the general partner also owes fiduciary duties to the partnership, which means they must act in the best interests of the business and its partners. On the other hand, we have the limited partner. This partner acts as a passive investor. They provide capital but do not engage in daily management or control. Because they don't take part in running the business, their liability is limited strictly to the amount they invested. Their role is primarily to share in the profits of the partnership without exposing themselves to the same risks as the general partner. Understanding this division of roles and liabilities is crucial when considering how a limited partnership operates, as it balances active management with risk protection for investors. To form a limited partnership, there are 4 key steps that must be followed to meet the legal requirements. First, the partnership must have at least one general partner and one limited partner. This structure is essential because the general partner manages the business and assumes full liability, while the limited partner contributes capital but has liability. When forming a limited partnership, one of the crucial steps is the state filing, which involves creating a public record. This is where the law of business and business organizations comes into play, guiding how these filings should be made and what information must be included. The key document here is called the Certificate of Limited Partnership. It serves as the official record that establishes the partnership with the state. This certificate must include several important details. First, the partnership name must be clearly stated, ensuring it complies with the state's naming requirements. Next, the certificate must specify the principal office address and the registered agent who is responsible for receiving legal documents on behalf of the partnership. Additionally, it must list the names and addresses of the general partners, as they have significant responsibilities and liabilities in the partnership. The certificate also outlines the business purpose, the duration of the partnership if it's not perpetual, and any other details required by the specific state's regulations. Filing this certificate with the state is what legally creates the limited partnership, making it an official business entity recognized by the law. Understanding these filing requirements is fundamental for anyone looking to properly establish a limited partnership and comply with state regulations. When we talk about limited partner liability protection, the key point is that a limited partner is generally not personally responsible for the debts of the partnership. This means their personal assets are usually protected, which is a major advantage. However, this protection isn't absolute. If a limited partner gets involved too much in the control or management of the business, beyond what is allowed by law or the partnership agreement, they can lose this liability shield. So, it's crucial for limited partners to stay within their defined roles to maintain that protection. This balance helps protect individuals while still allowing the partnership to operate effectively. Now let's focus on the role and responsibilities of a general partner within a business organization. A general partner plays a crucial role by managing the daily operations of the partnership, ensuring everything runs smoothly on a day-to-day basis. They also have the authority to bind the partnership in contracts, which means their decisions legally commit the partnership to agreements and obligations. Importantly, general partners owe fiduciary duties to the partnership and to each other, which means they must act in good faith and prioritize the partnership's best interests. Another key point is that general partners bear personal liability for the partnership's debts, so their personal assets can be at risk if the business incurs debts or legal claims. Essentially, their core role involves a combination of control and risk, as they oversee operations while also being personally accountable for the business's financial obligations. This dynamic is what defines the position of a general partner in the realm of business organizations. When we look at control and management rights in a limited partnership, the key point is that limited partners typically protect themselves from liability by not participating in management. This means they usually stay passive investors and avoid involvement in day-to-day operations. Control is generally held by the general partner, who runs the business, makes all operational decisions, and takes on the responsibilities that come with active management. Limited partners are restricted from managing operations, directing employees, or binding the business in ordinary transactions. Their role is more about investment than management. However, there is an important exception. Limited partners often have the right to approve major decisions. These can include things like amending the partnership agreement, admitting new partners, selling significant assets, or even dissolving the partnership. This voting power on extraordinary matters allows them some oversight without stepping into daily management. So in summary, the general partner maintains control and operational authority, while limited partners remain passive, safeguarding their limited liability but retaining influence over key high-level changes. This distinction is crucial in understanding how limited partnerships balance investment protection with effective business management. Now, let's talk about how profit and loss are distributed in a limited partnership. The key point here is that sharing both the gains and the losses is mainly determined by the partnership agreement. This means the way profits and losses are divided depends on what the partners agree upon. If the agreement doesn't specify how to allocate these, then the distribution typically follows the value of each partner's contribution to the partnership. Another important principle is that cash distributions have limits. A partnership must ensure that any distributions it makes do not leave it unable to pay its debts. This means the business should remain financially solvent even after distributing profits to the partners. So in summary, the three main principles to remember are: first, allocation is controlled by the agreement. Second, if no agreement exists, allocations track contributions. And third, distributions can't jeopardize the partnership's ability to meet its financial obligations. These rules provide a framework to manage profits and losses fairly and responsibly. Now let's talk about the transferability of partnership interests, which varies significantly between limited partners and general partners. Limited partners usually have the ability to transfer their economic interest in the partnership without much restriction. However, if they want to completely substitute themselves in the partnership, meaning take over all rights and responsibilities, this often requires consent as outlined in the partnership agreement or relevant statutes. On the other hand, general partners face much stricter limitations. Because they hold management authority and carry personal liability for the partnership's obligations, transferring their interest typically cannot happen without approval from the other partners. This distinction is important because it highlights how control and liability influence the ease with which partnership interests can change hands. Understanding these rules helps clarify why limited partners have more flexibility, while general partners must be more cautious with transfers. When a partnership dissolves, it doesn't just end abruptly. Instead, the process happens in an orderly sequence. First, a trigger event occurs. This could be a specific event outlined in the agreement or a partner deciding to withdraw. Next, the partnership needs to settle all its liabilities. That means paying off creditors before anything else. After that, any remaining assets are distributed among the partners. Now let's talk about the tax treatment of limited partnerships. One of the key features here is pass-through taxation. This means that income, losses, deductions, and credits generally flow directly to the partners rather than being taxed at the partnership level. This is important because it helps avoid double taxation. However, there is election flexibility. Limited partnerships have two possible tax treatment paths. The first option is to maintain the default pass-through status, where income passes directly to the partners. The second option allows the partnership to elect corporate tax treatment if desired. Choosing the corporate election means that the partnership will be taxed at the entity level, similar to a corporation. It's important to note that even with a corporate election, state filing requirements and franchise taxes may still apply. So, while limited partnerships typically benefit from pass-through taxation, there is flexibility depending on the business's specific needs and goals. Limited partnerships offer a unique blend of benefits that make them particularly attractive when you need to balance capital investment, liability protection, and centralized management. One key advantage is the ability for limited partners to invest capital passively. They put money into the business without having to manage day-to-day operations. This is ideal for investors who want exposure without involvement in daily decisions. Another important benefit is the liability shield. Limited partners typically face risk only up to the amount they've invested, which helps protect their personal assets. Then, there's flexible profit sharing. Unlike many other structures, a limited partnership allows partners to negotiate how profits and losses are divided, providing adaptability based on each partner's contribution and agreement. Finally, pass-through taxation is a significant advantage. Instead of the entity paying taxes, income is generally passed directly to the partners, which can help avoid the double taxation common in some other business forms. Altogether, these features make limited partnerships a strong choice for blending investment, control, and protection. Let's dive into some of the key disadvantages and risks associated with limited partnerships. While they can be great for attracting capital efficiently, there are important trade-offs to keep in mind. First, unlimited liability is a significant concern for general partners. This means they remain personally responsible for partnership debts and obligations, unless there's some other form of liability protection in place. Second, limited partners must remain passive. If they take on too much managerial control, it can blur their roles and lead to disputes over whether they should still have liability protection. Third, limited partnerships involve more formalities compared to general partnerships. State filings, certificates, and ongoing compliance all add to the cost and administrative burden. Finally, transferring or exiting interests can be complicated. Often, transfers depend on the partnership agreement, and investors may face illiquidity or limited control over when they can exit. These four pressure points, formation, governance, liability, and exit, are crucial to understand when dealing with limited partnerships. Here we compare limited partnerships, or LPs, and limited liability companies, or LLCs, focusing on liability protection, management, and tax treatment. Starting with liability protection, in an LP, limited partners are generally protected from personal liability, but the general partner remains exposed to risk. In contrast, in an LLC, all members typically enjoy limited liability, providing broader personal asset protection. When it comes to management, LPs have their management centered in the general partner, while LLCs offer flexibility. They can be either member-managed or manager-managed, letting the owners decide how they want to run the business. Regarding taxes, both structures usually benefit from pass-through taxation, meaning profits and losses pass directly to the owner's personal tax returns. However, LLCs can elect different tax treatments if desired, giving them more flexibility. In summary, while LPs and LLCs offer similar tax advantages, they differ significantly in control and risk exposure, with LLCs providing greater management flexibility and broader liability protection. Let's compare limited partnerships, or LPs, with S corporations. Both structures offer the benefit of pass-through taxation, which means income and losses pass directly to the owners, helping avoid double taxation. However, there are important differences. In an LP, limited partners have liability protection, but the general partner remains personally exposed to risk. On the other hand, in an S corporation, shareholders typically enjoy limited liability protection across the board. When it comes to administrative requirements, LPs tend to have fewer formalities, although you still need to handle filings and maintain a partnership agreement. S corporations require more rigorous corporate formalities, including maintaining corporate records, holding elections, and adhering to shareholder restrictions. Understanding these distinctions is crucial when choosing the best entity for your business needs. When we talk about fiduciary duties in limited partnerships, there are three main obligations that general partners must uphold: loyalty, care, and disclosure. First, loyalty means the general partner has to put the partnership's interests ahead of their own, avoiding any conflicts of interest or self-dealing. This ensures all actions benefit the partnership as a whole. Next is the duty of care, which requires managing the partnership's affairs prudently. This means steering clear of gross negligence, reckless behavior, or any kind of misconduct that could harm the business. Lastly, the duty of disclosure is about being transparent. General partners must provide all material information that other partners need to protect their interests. Since general partners hold the management authority, they bear the greatest responsibility for upholding these duties, ensuring the partnership operates smoothly and fairly. When we talk about amendments and modifications in business organizations, it's important to understand which parts of a business agreement can be altered more easily and which parts are more rigid. On the one hand, things like profit and loss allocations, terms for admitting new partners or partners leaving, and management and voting procedures are often modifiable. These areas tend to be more flexible because they relate to how the business operates internally and can usually be adjusted as the partners see fit. On the other hand, some elements are less easily modified. For example, the information that's already been filed with the state, core liability protections, and rights that require unanimous consent or specific statutory compliance usually can't be changed lightly. These parts form the backbone of the business's legal structure and protections. Now, when an amendment is necessary, the typical flow starts with voting. You need to check your partnership agreement first to figure out who must consent to the change. Next is approval. This involves securing the required threshold of partner approval, which varies by agreement or state law. Lastly, filing may be required if you're changing terms that were part of the original public formation documents. Internal terms might just need agreement among the partners, but anything involving state-filed documents usually must be formally filed with the relevant government office. Understanding this process helps ensure that amendments are done legally and smoothly. Respecting both the flexibility needed for business operations and the legal requirements protecting the organization. Here, we're looking at how the limited partnership structure plays a crucial role in private equity funds. Essentially, this setup separates capital from control, making it ideal for pooled investments. Investors come in as limited partners, meaning they contribute the money but don't manage daily operations. The private equity firm acts as the general partner, taking charge of managing the fund. This arrangement gives limited partners liability protection, as long as they steer clear of day-to-day control. Profits are typically distributed according to the partnership agreement, often including carried interest, which rewards the general partner for performance. The key concepts here are capital pooling, management authority, and the liability shield that this structure provides. When it comes to real estate development, the structure often involves developers acting as general partners. This means they have control over the project and make the day-to-day decisions. On the other hand, outside investors usually come in as limited partners. These limited partners provide the capital needed for the project, share in the returns, but importantly, they have liability protection. So while many investors contribute funds, control remains consolidated with one manager, the developer. This setup allows for efficient decision-making while balancing investment risk and return, which is a key concept in real estate development partnerships. Now, Let's dive into some important regulatory considerations for limited partnerships. First, state law plays a crucial role. Each state has its own statutes governing the formation, filing requirements, and partner rights. These local rules can significantly affect key issues like liability exposure and how the partnership may be dissolved. So it's essential to understand which state's laws apply and how they might differ. Next, securities law compliance is vital. When partnership interests are offered to investors, both federal and state securities laws come into play. This means we need to pay close attention to exemptions, proper disclosures, and anti-fraud regulations to ensure everything is above board and to protect everyone involved. Finally, tax regulations are a major factor. How the partnership is classified for tax purposes, the reporting obligations it faces, and how profits and losses are allocated among partners all impact the economic value of the partnership. Without careful tax planning, the expected benefits of the partnership structure could be severely compromised. Overall, limited partnerships are governed by much more than just the partnership agreement itself. Understanding these legal and regulatory layers is key to successfully managing the business and protecting everyone's interests. Let's talk about some common pitfalls to avoid when dealing with limited partnerships. There are 4 key errors that can seriously undermine the benefits of an LP. First, skipping the formal filing. Without the proper certificate, the limited partnership status may not even be recognized, which can cause major issues down the line. Second, blurring control roles. When limited partners get too involved in management, it can lead to disputes and jeopardize their liability protection. Third, having vague profit terms. Unclear rules for profit allocation often result in conflicts when it's time to distribute earnings. And finally, ignoring exit provisions. Without clear agreements on transfers, withdrawals, or dissolution, these processes can become complicated and contentious. By steering clear of these mistakes, you can preserve the advantages that make limited partnerships such a flexible business structure. To wrap up, the best results come when we clearly separate liability, authority, and economic rights within the partnership structure. Remember, a limited partnership requires at least one general partner and one limited partner. General partners handle management and typically face personal liability for the partnership's obligations. On the other hand, limited partners maintain liability protection, as long as they avoid taking part in management decisions. The key details about ownership, distributions, and transfers are primarily defined by the formation filings and the partnership agreement. Finally, limited partnerships are an excellent tool for raising capital, but it's crucial to respect the boundaries of roles and follow compliance rules carefully. This balance ensures the partnership operates smoothly and protects everyone involved.